The FTSE 100 faces a turbulent morning. Can corporate earnings save the day? The London Stock Exchange kicked off Thursday with a mixed bag of emotions as the FTSE 100 dipped 23 points to 9,754, leaving investors wondering what the day would bring. But here's where it gets interesting. A slew of corporate earnings reports are set to hit the market, potentially injecting some much-needed energy into the index. And this is the part most people miss: how individual company performances can sway the entire market's trajectory. Sainsbury's steady hand, a temporary calm or lasting stability. At 10:04 a.m., Sainsbury's was holding its ground, but for how long? Third Bridge analyst Orwa Mohammed believes the supermarket giant has entered a period of stability, as evidenced by its optimistic half-term report. However, with Asda regaining its footing and Aldi sharpening its pricing strategy, maintaining market share gains won't be a walk in the park. The real question is, can Sainsbury's continue to thrive in an increasingly competitive landscape? The company's secret weapon lies in its own brand range, particularly its premium lines, which have cultivated a loyal customer base. Additionally, its smaller store network, though still behind rivals like Tesco, holds untapped potential in the convenience sector. Yet, realizing this potential will require time and strategic effort. Online grocery, however, remains a challenge, with Sainsbury's playing catch-up in terms of availability and delivery experience. Analysts suggest a bolder approach might be necessary, even if it means short-term setbacks, to secure long-term growth and customer loyalty. Shares were up 1.5%, reflecting cautious optimism. Helios Towers shines bright, a bold plan for the future. At 9 a.m., Helios Towers stole the spotlight, soaring 15% to 178.6p after unveiling its ambitious 5-year Impact 2030 plan. This telecoms infrastructure group, operating across Africa and the Middle East, promises investors a rare combination: robust growth and substantial cash returns. With a target of over $1.3 billion in recurring free cash flow and $400 million in shareholder returns through buybacks and dividends, Helios is setting a high bar. A $75 million repurchase program begins today, and dividends are set to commence in 2026, growing at an annual rate of over 10%. CEO Tom Greenwood hailed this as the company's sweet spot, and investors seem to agree, with Helios radiating confidence. Medical stocks drag FTSE into the red, a temporary setback or deeper issues. By 8:44 a.m., the FTSE had turned red, largely due to declines in medical stocks. Hikma Pharmaceuticals led the fallers, dropping 12% after cutting medium-term guidance for its injectables division. The company also announced the departure of its injectables divisional CEO and a restructuring of R&D operations. Analysts at Peel Hunt noted that this segment, historically the most profitable with margins around 35 to 38%, is now expected to see margins closer to 30% due to delays at a new manufacturing facility, partly attributed to global supply chain challenges. Smith & Nephew and Metlen Energy and Metals also saw declines of 8.2% and 6.2%, respectively, following their quarterly results. This raises a thought-provoking question: are these setbacks temporary, or do they signal deeper challenges in the healthcare and energy sectors? BT Group holds firm, steady earnings amidst declining revenues. At 7:58 a.m., BT Group reported first-half results largely in line with expectations, with earnings remaining flat despite a falling top line. Second-quarter revenue of £4.93 billion slightly missed analyst forecasts of £4.97 billion, while EBITDA of £2.08 billion marginally exceeded expectations of £2.04 billion. CEO Alison Kirkby emphasized the company's focus on the UK market and its radical simplification and modernization plans, which have helped offset declines from international and legacy businesses, as well as higher labor costs. The board increased the interim dividend by 2% and reaffirmed full-year guidance, signaling confidence in BT's strategic direction. AstraZeneca beats expectations, a beacon of growth in the FTSE 100. At 7:40 a.m., AstraZeneca, the FTSE 100's largest company, delivered a strong set of third-quarter results, surpassing revenue and core earnings forecasts. Revenues climbed 12% to $15.19 billion, beating the consensus forecast of $14.8 billion, while core EPS rose 14% to $2.38, exceeding expectations of $2.30. CEO Pascal Soriot highlighted strong underlying momentum across the business, setting the stage for continued growth into next year. This performance not only bolsters AstraZeneca's position, but also provides a positive note for the broader market. Looking ahead, can corporate earnings lift the FTSE? As the FTSE 100 started Thursday in low gear, the influx of corporate results from major players like AstraZeneca, BT, Sainsbury's, Diageo, ITV, National Grid, Smith & Nephew, Tate & Lyle, Wise, Vistry, and Howden Joinery could provide the necessary fuel to drive the index higher. Overnight, U.S. stocks rebounded, with the Nasdaq, Dow Jones, and S&P 500 all posting gains, despite the ongoing U.S. government shutdown, now the longest in history, costing the economy an estimated $15 billion weekly. This global context adds another layer of complexity to today's market dynamics. Controversial question: are we overlooking the impact of supply chain challenges on corporate performance? As we dissect today's market movements, one controversial interpretation stands out: the recurring theme of supply chain challenges across sectors, from pharmaceuticals to telecoms. Could these disruptions be a more significant threat to corporate growth than we are acknowledging? Share your thoughts in the comments. Do you think supply chain issues are a temporary hurdle or a long-term obstacle for global markets?